That day, you knew that you have lost 20 million or 30 million euros, right? And that's a lot of money for, if you think about it. But then the next day you maybe have made it.
Super unpopular opinion, but I love it. I love it because I see the thesis.
And from 1 billion, the return is happiness. Yeah. Go to a beach, and enjoy life.
Okay, good. So not investing at all.
No, just spend it all. Make money for the rest of humanity, Consume. I hate this. Let's put it out there.
María Juesas.
Yeah.
Welcome.
Thank you.
Thanks for coming today.
Thanks for inviting me.
I know you're very busy, but thanks for coming. First question, right away.
Tell me.
If you have to give an advice to anyone that has some savings between 100 euros to 1 billion, what they could or he or she expect to get as a return in the next 5 to 10 years?
You said from 100 to 1 billion. Okay, the one from 1 billion, the return is happiness. Yeah. Go to a beach, and enjoy life.
Okay, good. So not investing at all.
No, just spend it all. Make money for the rest of humanity, Consume, basically. The rest of people will actually appreciate it. No, I think it depends on the risk that you want to take with your 100 or 1 billion or whatever. I mean, at the end of the day, the return profile is a risk return profile, right? So it depends on how much risk you're hoping to have, how much return you should be expecting. But if you go from like things that have zero risk, which at the end of the day will be like bonds, right? That are giving you around 3 to 5%, depending on what they are, taking into consideration bonds that are investment grade. So things that are secure in a way, like US bonds or European bonds. Yeah. So that will give you between 3 to 5%. Year to date, right? At least they are at this point.
Unless the country go to bankruptcy, which
yes,
in most of the cases.
But we're not doing. But we're not saying countries like Brazil or Argentina or Venezuela where they high yield, so the different type of risk return profile. I'm talking about US or European bonds. So that's like the minimum that you should be expecting. And then if you think of the risky, not taking into bonds, equity, so all the public money that you can invest in with 100 euros, right? Not all the alternatives that you will not be able to invest if you are a normal person with 100 euros in your pocket. And then if you go to the equity markets, the S&P is returning around 20 something percent. And then the Nasdaq is already at 30 or 30 something percent, right? So you should be expecting something in between those lines if you want to have a more distributed type of portfolio construction. Now, if you enter into you mix some more for the people that has more money, some other type of assets, like you will have real assets, you will have private equity, hedge funds, venture capital, commodities, some other stuff, then the return profile will look different, right? It will be more like an endowment type of model. That it all depends on your risk profile and how many years you want, or what's your the time period or the time horizon of your investment.
Yeah, that's also super important. Yeah.
But yeah, if you have 1 billion, just do what you enjoy, enjoy life, and help others.
What I've seen, funny enough, is that actually the people that has more money, they tend to invest more than the people that have less money.
Yeah, I mean, obviously.
You have something to protect.
Well, two things. You have to pay your food as well at the end of the month, right? So it's tough to... it's two things, right? One is tough to actually invest in some of these more complicated or not plain vanilla type of structures. And then the second one is like if you have 100 euros, the reality is you need to compound your money. So you need to save your money little by little and then start investing it in something that just the commission is not going to kill it. You are never, and you should make sure that that money is not going to be retrieved in short time period because the commissions will, kill pretty much everything that you have made with that investment. So there is things that you can invest the money, obviously, and I think more and more, thanks to crypto, actually, I think many people that have like little amount of money has been able to invest more actively than it was done before. But yeah, I mean, when you have 100 euros of savings, you also need to think of your disposable income, right? And I think that type of profile of people maybe doesn't have that disposable income to, allocate some capital to savings and make sure that that capital is not going to be touched for a specific amount of time, right?
Yeah, makes sense. And actually, you were mentioning this year's S&P and Nasdaq to 20 to 30%, which is way higher than usual. I would say that the last 20 years would be around 8% or something like that, I guess. And as you said, it all ties together with the risk. But why did I ask you this? To start with, it's just because you have a wide trajectory in the investment world in a broad sense. Because instead of me telling your story, can you tell a little bit your story? You've been in many different countries working for different types of asset class. Can you give a little?
Yes, where should I start from my
from the very beginning? No, at least so that people can have like, look, I did this in here, I did this in here, I did this in here, and now in this.
Okay, so then basically born and raised, and the accent can tell you from Spain.
Both accents.
Yeah, exactly. Then I got granted to study in the US. So I graduated from North Carolina University. And then after that, I managed, not through connections, but honestly, through creativity thinking, I think, in a way, to get into the hedge fund world. So I started my career in the hedge fund world in New York. So I basically, my first 6 years of my career have been in hedge funds. Half of those in a strategy inside of hedge funds that is called Global Macro Emerging Markets. And then the other hedge fund was long-short infrastructure and energy. So the first hedge fund, the Global Macro one, were products that were like buying or selling derivative products. Could be like CDSs, IRSs from different countries. Could be Brazil, CDS, or could be an interest rate swap between Europe and the US interest rates. Could be bonds from different countries, or indexes in terms of not just company stocks, but like indexes in a way. So that was one of the strategies that I was at the beginning. Then the second strategy also.
Excuse me, what was there at the beginning, more or less assets under management?
I don't even know if I could disclose that.
Okay.
That's a different question.
Okay.
But it was in the hundreds, that's for sure, that I can say.
Okay.
But so the assets in many places, they don't like to disclose them, and I don't know if they're public or not. If they will be public, I don't know if they are or not, but in the hundreds for sure. I mean, a few hundred. So
yeah. Okay, that was the first. You were moving to the second.
Oh yeah. So that's to the second point. So the second fund, it was a London-based hedge fund doing long-short infrastructure and energy. So basically, the strategy is to hedge yourself by buying and selling either the stock itself or derivative products for those stocks, like options could be, right? And the idea is to buy or sell stocks from energy or infrastructure companies underneath, right? And then you can hedge either with some other companies, or you can hedge with the indexes as well. Right? Sorry, in the first one, the global macro, we also used to do FX. I forgot to mention in this one.
Can you give a little bit, just because also you mentioned the time horizon that is super relevant. Can you mention as well the time horizon of the investments?
In each of the strategies?
Yeah.
Yeah, absolutely. So the global macro one used to be a little bit more long-term view, because you invest into, so the idea behind was you do two types of analysis, right? One is more of a fundamental of the macro of a country and is trading partners as well, and how the world will impact that country. So normally those things don't change materially unless something vital happen, or if you're doing a parity trade in between two countries, the other country gets affected, so then therefore your trade will get affected, right? And then if it's on a view for the years, so for instance, you could also have like different instruments that you could be saying, okay, I believe that on the short term, the interest rates are going to be lower than the long term. So then you play around with this type of instruments to make sure that you make money out of both angles, right? On the 10 years view and on the 30 years view, in a way, right? So in order to do that, there is a few, you can do a trading analysis, you can do fundamental analysis, you can do different type of analysis on that, right? But the reality is, in most cases, you don't have a position for one day. It's not an intraday, right? You have a position for either some of the positions of the book, to be honest. Since I started in the hedge fund and when I left the hedge fund, they were pretty much there. The size of the trade were different, right? And you were buying and selling depending, but there was a really long-term view on one specific country in that regards, right?
Interesting.
And then you could hedge or you could avoid the hedging because you believe, but the long-term view in some instruments was there. Now, in some others, it was a matter of like a week or, like a month. And then when it came to currency, that also depends massively, right? Massively on the country, on like if it was a specific event that you were waiting for it to happen, so then you can take the profits after the event happens, right? So that was a little bit more. But again, it's not an intraday. It's not you enter one day and you leave the next day, right? It's except for the event type of situation. Most of the cases were like a little bit more long-term views of it. And in the case of the second one, it was more a fundamental. It was the entry points and the exit points were trading analysis, but the reality is like the belief on the company was more of a fundamental analysis of a company, right? And then at that point in time, you came up with, after a lot of modeling, etc., you came up with a price. And that's the price range, more or less. Yeah, more or less. It's not a target, as in like this is the magic number, but it was more or less of a target versus where it is right now and where everyone is saying it is, and etc. So then you should be selling. You should be going towards that target, either it's buying or selling,
Okay.
And then you take profits in the way as well. So you do something a little bit more trailing. How long that can take? I mean, it depends, It depends how the flows are. It depends which company it is. I mean, there's some companies that have like a huge liquidity. So you can enter, these days NVIDIA is one of those, you can enter and out like so easily. But there is some other companies which the actually liquidity that they have is quite short, right? So it will take time if you don't want to move the market on that specific stock, a little bit of time to actually get out and in and out of a company.
Because also in this case, you have the risk of moving the market against.
In the ones exactly. Well, not against. You basically are affecting the price that you enter, right? So you will not enter at let's say 4. You will enter some tranches will enter at 4, but then if you move it significantly, then some other tranches will enter at 4.5. To give you an example, a little bit.
Was this also in the volume of this fund was also like in the hundreds or?
Yeah, I think at peak they reached billion, but I don't remember exactly. But yeah, more than 500 for sure. Yeah, in both cases, and they were like a small hedge funds. It's not like the big hedge funds, obviously.
Yeah. I was thinking that the first one must be, I guess the second one too, but the first one like particularly stressing because if any news or whatever related to the political situation of the country that you're operating in happens, that could drastically change your perception of the country and make you get out.
Yeah,
like from one day to another.
Yeah, that 100%. You think of Argentina when they default. There's things like that can happen, right? But I don't know. I don't know if I was young or I've always been like this, but I didn't find it stressful. I actually, the first one, the second one is completely different. For me, I was not so enticed to that personally. Okay. But the first, because the market didn't move that much. The type of assets also is not like it's extremely super volatile. So it's not like you're looking for assets, So it was less of the case. But in the first one, it is 100% the case. I mean, you were looking into what it was crazy. I think I didn't realize at the time because either I was too young or too naive or whatever it is. But there was something happening. I remember one trade happening, and then that day you knew that you have lost 20 million or 30 million euros, right? And that's a lot of money for if you think about it. But then the next day you maybe have made it, or like the volatility was extremely high in certain geographies, right? But the funny part is, not the funny. It's not funny, but the crazy part is actually that you will see some other hedge funds that were same strategy as you, potentially going out of market, like completely out of business, in one trade, right? In one day, on one trade, it happened it has happened with a few hedge funds when I was doing that, and I mean, I can. It's huge risk, right? In theory, you believe the fact that you have different. I mean, you believe it and you see it every day and you control it every day, but you have like these risk measurements that you control really, really, really tight to make sure that you are able to control the loss in every single point of the day, right?
Yeah.
So then you can actually, and that takes into account, so the risk modeling is actually really important because that actually takes into account how much it takes you to liquidate the book, right? So then if things starting to go wonky, you know how much is your maximum loss given the whole situation, and what was your maximum loss in when everything went to in the worst situation. Exactly, I don't want to say a bad word, but in the worst situation of every major crisis for every major asset. So not all the assets in my case had the same major crisis at the same time. So some of the assets will have had, for instance, like the tequila crisis. The others will have been the worst time on the market will have been the 2008 crisis, and then some others will have had the financial crisis, etc. So the reality is for each of these assets, you will have what was the worst time in history, how much it took to liquidate that, what's the liquidity, so, and then you get a maximum loss in a way. The maximum loss is actually extremely conservative.
I can imagine.
But that depends on every manager and every hedge fund manager, and they have different systems to calculate it. So that was, for us at least, was super important to have like a really conservative system for those reasons. And then you will control that as if it was your Bible in a way, right? Every single day and every single time.
The only certainty is that you did already the worst case, and you need to like.
And then you need to, and it basically lets you know. So that we had like some flagging systems for us to let us know when we had to start liquidating part of the book or like doing tranches or start. So then you always will get notified of like, hey, you need to execute something in the OTC market. But most of these assets were OTC, right? They were not like you can have a click on a button and say, I'm buying X amount, I'm selling the X amount, right? Yeah. So you always need to get a pricing from someone.
OTC is over the counter.
Yeah, over the counter, exactly.
Really.
So it's a person on a person, right? If you are talking to a bank, in most cases, and then the bank says, hey, I have this bid-ask spread. You're going to execute how much tranche, and then you execute the tranche, right? So it was stressful. I didn't perceive it like that. It was, being honest.
How many hours did you put a day?
I don't know, because I was so excited and I was learning 12, so much. Okay. 12. That's soft. 12 is nothing. No. I put like I don't even remember, because at the time I was so naive. I was just new to the market. I was seeing all these crazy things happening around me. I was invited to all these crazy events for like speaking to the central bankers or whatever, going to this Goldman Sachs does this research meeting or dinner or lunch for whatever. And then I was so impressed with everyone and I felt like so clueless that I remember spending like 12 is nothing. Like I remember almost sleeping 4 or 5 hours during some weeks, because I wanted to. The problem is no one was asking me to do it. It was more like I wanted to learn it all and as quick as possible, because I was feeling like such a, out of place, that I was like, no, I need to learn. I don't even know what this means, and I don't know why he says that if this happened, this other instrument will change in this way when I think it was different from that. And you wanted to understand it because you saw what happens when you're wrong, right? So no, I mean, I didn't see it as stressful, but if you look back into it, and it's potentially really, really stressful. But
yeah. Also, it's true that if you take into account the events and like part of social working life, you can start at 7, and then the last event you may have it at. So you start at 7 a.m. working, you may have the last event at 7 p.m. that could last until 1 a.m.
or more. Or more. No, but like I was not even talking about the events. I mean, that's in another point, but I was talking more like looking into big books and trying to understand or looking into the back end of the risk and how it works. I was actually, or like studying specific trading theories or like, or doing like regressions or things like that, or modeling stuff. That's what I meant, like a lot of hours, because you wanted to understand how everything worked, right? And it was not just the fun part, which is like obviously all these events, dinner, lunch, etc. But it was also like the work that you have to do behind in order to get into some of these things and having a say, right? Like you don't want to get there and just be not having a view on what's going to happen with Japan or what's going to happen with Brazil, or what's going to happen, in the next, or what was actually said, or what was the sentiment of the last press release from the central bank. Like you had to do the work before being able to have these conversations. And they change so much every day. So it's not that you have to do,
It's full of new news that is affecting.
From different countries, So you have to be on the news, you have to be knowing everything, more or less on each country that you are looking at, basically. So it was a lot of, but it was really interesting reading, actually. It was not...
I mean, it seems super interesting, to be honest. Like, I want to disclose a fact about you, because you will not say it. I think that the funny thing is that you were dealing also with something that you mentioned before, the price range, kind of the objective price range of a company in your second experience. But funny enough, you don't do trading with your own money. You don't, if I'm not mistaken, you don't do that.
Why?
You arrive to the holy grail of the models and everything that everyone is fighting always. Like, yes, I will get to a target price range, and then I will apply a margin of safety, and then I will invest all my money in it. 20-30% margin of safety, like the Warren Buffett's mentor. I forgot the name. That has huge book about the margin of safety. Graham, I forgot the name. My gosh. Well, and you don't invest yourself.
No, I mean, well, I do invest myself, but it's different from trading in the public markets. I do invest. That's a different story. And what are the assets that I invest? It's a different. I do invest in assets, risky assets. Please never. If anyone is listening to this, don't do it. It's the worst portfolio construction ever in your life.
This is just so weird.
I know. But so there's a couple of reasons. One is I wanted to put most of my money into angel investing because I wanted to build also a track record on something that I like to do. So that's what I meant. No one should do that because it's extremely risky. You're gonna lose a lot of money.
I agree.
And but the reality is, luckily, it's going well. But the reality is like that's never a good thing. You should not be doing those things. But for me, it was more like, look, I wanna build something for my track record. I'm not confident of asking people for money. The best way to do it is creating this syndicate and together with other 3 friends in the industry, and then build and invest in something, right? If it goes wrong, look, I'm still, not young, but like relatively young, could continue working and I will make money again, in the sense of I will make my savings again. That's one of the reasons why I put more money in that and nothing in other assets.
So more money basically in the startups rather than in public markets.
Yeah. And you also sometimes, time to time, you put money into indexes, I also play around with crypto, like two other assets time to time. But the public markets, the problem, I don't know if it's because I understand them really, really well, that if I wanted to put money into anything, I will want to make a model, a really good model, and then I would like to track that company by heart, right? That I've done in the past with like companies, specific companies that I wanted to invest into for X or Y, Z, you know. But then I will track them really, really closely and modify and do my things with this company. But I don't have the time in my life, and I don't put that as a priority right now. It will become a priority at some point in my life, 100%. It is not a priority now because I still want to do other things. It's not, you know. So then I don't know if it's because I am too careful or too risk averse in a way of doing something without doing it properly, or too perfectionist. I don't know what it is. But in my mind, it's like I'd rather, if I'm not going to underwrite a company the way that I know I can do, and I'm not going to track that company every single day, the reality is I'd rather put in an index, you know, or like a bunch or like a basket of different things, and trying to that way optimize. Otherwise, if I will have time and I will have the if I will have time and my mind being more focused on this, I will potentially do my own basket of assets, 100%. And I did at some point in my life, but not right now.
Okay. And because right now your focus is on some of the things that we will get eventually. But so you were talking about the global macro emerging market, the long and short in the energy sector. Then we keep moving forward.
And then, I so that was my public market type of experience. And then I moved from the public market to the private market. I actually got in, well, thanks to a friend and also by coincidence, but I wanted to change, and I thought the best way to change careers and do something next was like enter into an MBA. So I decided to enter into an MBA between London and then do like 6 months exchange program, whatever it is, in Asia, because I had my undergrad in the US. I was going to do my MBA here in Europe. And then I was like, well, the only remaining part that I have missing to kind of understand how the learning systems are in each of these continents, then I wanted to do part in Asia. That was kind of the missing part. So then you kind of have the wider spectrum of how people think, how different cultures think, how different cultures analyze one same topic at the end of the day, which is financial markets. But then, coincidentally, as someone in the industry that I respect a lot and is also is one of the smartest people I know, and she's also one of my best friends, to be honest. And she came one day. I was living in London at the time, and then she came to London. She stayed with me. She's like, "Hey, I'm working in this thing." It's kind of like it was really well structured. And to be fair, I have to admit, like it was really well done, and it was really thoughtful the way that it was done at the beginning. So basically, there's this corporate venture capital out of one of the largest Spanish banks. That the way that they had structured it was like they wanted to hire a pool of people that was kind of really strong people coming from international, either from different financial areas or from strong consulting firms. So it was this team that was basically 3 teams inside of the corporate venture capital. And actually the CEO of that corporate venture capital, super strong guy, has studied abroad, has worked in many places, consulting background as well, investment banking background as well. And then now he has his own startup in New York. Super strong guy. He's the one that kind of starting with the vision, and the vision was really, really good. I was like kind of having like investment team and a strategy team, and then a venture builder team. The venture builder was more like a proof of concept, which I think pretty much every corporate has tried. It's kind of they have this money, this pool of capital to try new things, and then when they don't work, it's not like the end of the world. They close it out and that's it, but they have to try, right? And I think that's kind of mindset is really, really good for many corporates to have.
You're talking about of Innocells from
Bank exactly, Bank Sabadell, and at the time, like originally.
Yeah.
And the good part is like the people that was mainly the CEO and the CEO at the time and the CTO were really, really strong. I think they were really visionaries, and honestly, I think it was a pleasure, the fact of how forward-looking they were. At certain extent, I don't think they are anymore in the bank because they have retired, etc. But I think if the markets would not have gone against them and they would not have had some other issues with the corporate itself, their vision was, I think, really, really outstanding. But, things happen in between. Yeah. But at the time, it was great at the beginning because we ended up building this super, and the people that was inside, honestly, from the investment side and the strategy side are all of them are really, really good friends of mine, and my best friends are from there, right? So it became like kind of a family in a way. And we were all people coming from outside or have had experiences outside, etc. So my friends say, hey, we're building this thing. It's super interesting. I think you will like it. And what do you think? And I was like, well, I used to work a lot in the hedge fund industry, so why not doing this at the same time that I do an MBA? So then I decided to do an MBA and working in this. And it was a lot of work at the same time, but it was actually great because we did, what I'm saying, like the buy-in from the bank at the time was extremely into this type of projects, and we did a couple of acquisitions in technology companies. We did a few minority stake investments, and for me it was actually the acquisition. One of them was that I did. I was on the full acquisition. Was a great experience from beginning to end, right? And I was actually with the ex CEO of the company that we acquired a couple of weeks ago in Madrid, and it's a super strong CTO and amazing company. So we did things that were really, really good at the time, and it was a great experience.
What was the thing that you liked the most about it? Because, as you know, I kind of like CVCs.
Yeah, I assumed.
The thing is, you said that you have these three teams: investment, strategy, and venture builder. I guess venture builder would be a bit on their own, and then investment and strategy would work more
exactly.
together.
Until the point in which obviously it was clear from the corporate that venture builder made no sense. Okay. Which I think that every single corporate venture capital has realized and has gotten to that point if they have done it before. And so then at that point, the strategy team also got involved into the venture builder, trying to decide what to do with them and to make them either spun out, either close the business, or either integrate it 100% into the bank and then solve the problem in a way that was the best solution, basically, for that. And then the strategy and us used to work together a lot. So basically, it was used to be one or two people from strategy and then one person from the investment side, or mostly one or two people from the investment side in specific projects or verticals. It could be like, for instance, insurance. So there will be a huge work around insurance of like, hey, how we can digitalize this better. That's obviously the strategy team was the one doing this more thoroughly, going into each of these divisions and saying, hey, what can we innovate in each of these sides? How we can increase the revenue streams, or how can reduce the cost? How we can optimize something, right?
So it's not a mandate from the CEO or something like.
No.
Modernize my insurance unit. It's like you were asking each unit, the strategy team.
We were going unit by unit to see where we can innovate, right? And it was it could be coming from two ways. One, it was like this type of consulting type of situations, or it could be as well from the investment side. That if we saw like a really strong deal, we will be like, hey, what do you guys think about this? And then we will go to the business unit. And if the business unit will be like, oh, actually, this is super interesting, we will do something around that, and we will think more around that.
This is what we call pull and push in here.
Exactly.
As well in Wayra.
Exactly. It will be exactly the same.
Which one will better? Sorry, like, is it normally easier to bring new companies into the business unit that they never thought that they could have that problem, or is it better the other way around, that the business unit will give you the needs and you will look for them?
I think it depends on the people.
It really
I think more than anything. I think there's either I don't think it actually matters. What I think it matters is actually the people that is in the team, if they want to do something new or not. I think the incentives of the business units is the most important part for something to actually surpass, the threshold that can be generated by an institution per se, right? And then also, I mean, the structure was great, right? But as all structures were great, at some point it came with problems, right? Either the management changed or the management had less incentive to push for this type of long-term kind of views of a bank or of a strategy, or there were like short-term needs that need to be fixed. And the reality is when you are like fully dependent on a corporate, right, and you are not independent of them, or like you have structures to create that independence, it's really, really tough to not move with the flow. And the reality is like some of these strategies, unless you have a really long-term view, if you move with the flow, you're never going to see materializing what you are doing, right? Yeah. So it's really tough to explain to someone, hey, believe in this because in 7 to 8 years, you'll see the benefit of this. But you're not going to see it in 2 years. Yep. However, the corporate could have its volatility of the market in the short term. So when things are good, no one cares. Do whatever you want, But when things are bad, they're like, why are we giving money for something that in my life I maybe not see what's going on?
That's the story of innovation.
Yeah. So, but it's true. It happens, and you also can you can understand their point of view. For the people that is sitting at those chairs at that time, right? So it is what it is.
And did you manage to have like common and shared KPIs between the operating business unit and your team, or you have your own KPIs that I guess it was?
No, we have our own KPIs. And the reality is like I think we discontinued the program by the time that we not me, but the people from the strategy was actually doing this amazing work for changing the incentives of the people in the bank, because they wanted to from the top, right? Like this will have been pushed, and actually the people that I was mentioning before, the COO, etc., was quite on board to do this, right? Which is basically make the people from the each business unit to push more for at the end of the innovation in different ways and forms, but innovation, right? And then at that point, when you keep KPIs for your bonus at the end of the year are attached to the ability to innovate or create value or reduce cost, or like in a more creative manner, you want to do things. You are open to do things. But when your situation is not like that, the reality is like you have zero incentive to help any startup or any company, or even us. Like I will go there and fight with them in order for one startup to be able to help them change something inside of the bank. Yeah. And they didn't want to, because at the end of the day, it meant a lot of work for something that is not even going to give any return to them. And you understand that point of view, right? It's not like I don't understand it. I don't agree with it. I will not be like that, but it doesn't mean that I don't understand them. So yeah, it became, at that point in time, it became a fight, and you can do up to a certain extent, but you also cannot, change something if it's not changed from the top to the bottom, right? So yeah, it was, I think that was the project that was going to be done, but then most of us end up leaving and discontinue the practice of the corporate venture capital at that point. And they consolidated with the internal balance sheet, other type of units that were in the bank for doing other type of projects in the investment side. So they continue investing in startups, but it's not the mentality and the project that it was built at the beginning, and it lasted for like a few years.
So would you even say that if the C-level or the board is not in line with opening or a CVC and they cannot impact the KPIs of the business unit, it makes no sense to have a CVC? Would you go that extreme?
I mean, it depends. If you have a CVC for financial return, then yeah. I think it depends on what you're aiming for, I mean, if you're aiming for to change and innovate and create new ways inside of a corporate, yeah, I would say, why would you invest in anything with the aim of building that, if then the business lines are not going to intake that innovation or are not going to participate on innovating themselves. So unless you create some incentives for them to intake that, why would you spend the money, Now, if your only concern is return, or you have a different type of for instance, if it's return, 100% you can do it, do whatever you want. Then if it's actually, there is another way of like, could add value, you could do it, but it's not going to change your processes, right? Which is saying, hey, this is a way for me to distribute my product. Then, you can do some of the stuff in order to distribute your product or distribute your services or distribute something, because you are building something within a new type of sector that maybe you were not penetrated before. So an example, for instance, maybe you do something on startups because you want them to give them a bank account, right? As a startup. And then you say, hey, you know what? I'm going to give them everything free at the beginning. And then once they start growing, then I will charge for the card, for the services on here and there,
Like AWS or Google Cloud.
Exactly. It's the same strategy. So in a way, I could see why you will do something around the corporate venture capital or the corporate and / technology world. But it depends what you aim on this program. So it's always on the objective. Depending on the objective, it will make sense or not.
Yeah, totally. And last question about this, maybe. In the case that you build this CVC based on financial return, would you put carry to the people that work there?
100%.
But not in the other case. In the case that they're working for the well-being of the company and getting new revenue, you don't think?
No, I think so. I mean,
in both
cases. I think it depends, right? One thing is, so it's, in a way, you're saying is like the carry will be distributed. So you can distribute. There's many ways that you can do this, right? For sure, if it's economical return, 100%, right? You are looking for the money, the same that the people that is working for you is looking for the money. So, there's no other way. And this very competitive, you need to make the standard of the market. If the standard of the market is another one, then, giving carry to people, then be mindful that if you want to have people that is actually good and strong, give them carry. Otherwise, they're going to leave. So full stop, there's no, I don't see it differently. Now, if you're thinking of having both the economical return and the strategic fit in a way within the corporate venture capital and the corporate and the corporate itself, then there is many creative ways that you can do that and still compensate people. Of course, you have to give them, I believe you have to give them carry because that's the standard in the market and the same applies in this case. But you actually can be even more creative because you can also give carry to people that's collaborating with them and making sure that this not only gets used, but gets integrated properly within the systems, which sounds like a easy word, but it's not an easy word or a streamlined word. So now how that gets distributed, it's a consulting, type of project. But most of these corporates have groups of people that their job is doing things like this. So it's not like they don't have it, right? So it's just being a little bit more open-minded and thinking outside of, I hate this word, but it's out of the box to try to get into a point that could benefit everyone that has a relationship with this type of companies, right?
Yeah.
But in both cases, it's like, depends the quality of the people that you want to have. So
Yeah. I, just to go a little bit in discussion with you in this, I think that if you looking to build a CVC based on financial returns, normally it depends on the case.
Which, by the way, it will not be a CVC anymore.
Yeah.
It will be a financial. It will be a financial structure
with one LP.
With one LP. Yeah.
Okay. Yeah. In that case, or in most of the cases, I would say that if you were in the board of the company, I would be more secure saying we're going to be LPs in different funds. But why build it myself if my goal is not to do something together, at least with the company that I get the money from?
To be honest, there's a few companies, successful ones actually. Borwick, the one from Thermomix actually. I was talking to them the other day. A friend of mine just moved there. A colleague and person that I know in the industry, not friend, but like, and then she was mentioning that actually they started as a corporate because the people from the top, they were like, we're going to build this. And then at some point they became really successful. So they decided, you know what? And it was mostly return driven, right? at some point. And yes, if there will be some correlation with the corporate, great, they will do something. Yeah. But if not, they don't care if the company was good or was strong. And then at some point, what they did was like, hey, we're doing really well. We've done really strong investments. So let's spin out. And they become, the corporate became an LP. In a multiple LP type of structure, right?
Okay.
So it was not anymore like only one LP structure. And that has been done by a few corporates. I mean, this is an example. But has been done through a few corporates that started like that, right? Yeah. Or they tried to do it at the beginning. They were like, well, I don't know. Let's see how it works, blah, blah. And then they realized that they get actually really amount of good companies. They are doing well. And then some of these companies that they get into the table are actually... some of them are not going to help the company either way, right? So they end up realizing that, hey, the ones that they can correlate or the ones that they can leverage the bank or the corporate behind to invest, they will do so. But there will be others that are purely return.
Yeah, yeah.
But the reality is, like, if you have a corporate, you should be leveraging the corporate for those investments. Either it is for creating value to those investments and you will create ultimately value for yourself, or for the ability to underwrite these companies better than someone else.
Especially the first point you just mentioned, it's my take on it. It's like, you may have actually some real smart money. If that exists, that is the case in CVCs. You can actually add something that the VCs are adding, but on top, which is the network and the good practices and you name it. But on top, I'm going to give you some special technological knowledge in one field, or special sales knowledge in one field. And I'm going to help you with my clients. Therefore, that's when, for me, it makes like...
But that's idealistic, right? What we are talking is idealistic. Then there is the reality kicking in. And working with corporates, it's many corporates and also many startups doesn't realize how tough that is and how resource constrained that
terribly
is.
Tough.
And so many times even they kill the companies in some ways, right? And the corporate doesn't even realize that they're killing a company, but they're killing the company because they don't have the resources to face all that bureaucracy, all the things that are going on around with them. And on top, the needs that specific needs that this corporate have for this startup. So it's not always like a clean cut. And then it depends on the stage of the company. It does make sense or it doesn't make sense. Now, the question is, can you collaborate with them and having a really interesting program without actually being in the cap table? That's a different question, right?
That's a different story, yes.
Because in some cases, I don't know.
The venture clienting.
Venture client. Because at some points, or like having other types of benefits out of this company that is not through the cap table. I don't know. I don't have an answer. I think there is a good answer for both. But in some cases where the company needs to be completely unbiased, if you put someone in the cap table or you build like a good diversified industry type of stakeholders, then in that case you are not biased towards one or the other, or you can position yourself as, hey, this corporate is backing this startup. I'm not going to work with this company because, it's being backed by my competitor. You can get into some of this. And then the other one is like, depending which is the corporate, there's some clauses that they put into some of these companies that are a little bit, not plain vanilla.
Correct. That depends on the CVC as well. But you were mentioning something super, super interesting also for the startups that it could be listening, and is the fact that, but that's the job of the CVC is this job, and it's adjust expectations in both sides, because when you talk to a startup, it's like, 100%. Man, especially if you're like pre-Series A or something, don't devote 4 or 5 FTEs to one single client. It doesn't matter who that is, because probably you may die in the process. And also on the other hand side, with the corporate, you have to be like, they are not your consultancy. They are building a product. Especially if you have the two hats that you can switch. So now I'm the company, now I'm the startup, now I'm the corporate. You can switch, you can actually try to mediate between both sides. And that's why I think this is the added value in a CVC, but maybe, as you said, also in an ideal world. But I've seen it.
No. And that's your job. Your job is being a translator to one side and the other side. A lot of the work is that. And make things move faster in one side and make them not getting desperate on the other side, you know.
It's zero fancy. It's zero fancy. I completely agree.
But still, I mean, I see the benefit if you want to work with the corporations. But you know,
Yeah.
it's tough.
Yeah.
Taking the fact.
But we're not yet done.
With what?
Because
Oh,
with Innocells, and then.
Okay. So
I know.
The with Innocells. So that was Innocells, and then at some point, as I said before, I think the incentives for this to continue forward were not there anymore. So then we decided to. I mean, in my case, I decided to leave, and then I went to. I had this thesis at the time of like, and it continues these days in a different way because a lot of things have changed in. I think it was 5 years already, but I had this thesis that the most important things that matters to people are actually needs to be changed through more hardware-driven companies more than software-driven companies. And I had
super unpopular opinion, but I love it.
Yeah,
I love it because
or things that, I mean, or kind of the next wave will have to be enabled, but by also an innovation on the hardware side, or hardware plus software, or software, but it's not the typical software. What I mean is like not the typical fintech company or the typical insurance company or the typical. Look, that was my thesis at the time. Can't say it's right or wrong. Depends, you know. If you look at the returns, historically, you say you're really wrong. But whatever. Actually,
no. Invested in Tesla in the beginning.
The reality is not really. If you actually look into the returns, most of the companies that have created value, like if you see in 1990, we were doing this analysis of like 1990 were the strongest companies in the public markets in the US were completely more real assets type of companies, and then if you see today, most of them are actually driven by what I will call like related to deep tech in general, right? Most of them. And then if you see the European one, it's a little bit different because you have LVMH and a few others, but it's also like quite correlated or that enabling by deep tech companies in the middle, right? If it's robotics or if it's semiconductors or if it's whatever it is, but it's like there's a high correlation that they were not in the 90s. The 90s was completely different, right? So actually, and then in the private companies, the same. Like if you see the top 500 companies here in Germany, which by the way, 90% of those are privates. They're not even public companies, and are the largest companies in Germany. 60-something of those are related to or correlated to deep tech companies, or they were in the time, so they use deep tech on their value chain, or they use deep tech to enable what they are offering to people, etc. So they're correlated to that. So in a way, no, even if you look at the return perspective, maybe not from a fund, because I don't think we've been investing into that heavily yet. I mean, in Europe, the longest fund that is only focused on deep tech is honestly been quite short in terms of a life, right? It's not that they have been here deep tech funds since the 90s.
Which one are you referring to?
I don't remember the name, but actually Vsquared is one of the early ones. I don't know if it's the first, but like maybe the second, third. It's not like, hasn't been. So it's not that, it's one of the early ones. Are
we jumping already to Vsquared?
No, not yet. Not yet. But what I mean, what I mean is basically I believed in this thesis. So then I went into more than in fintech, and I was like, hey, if you're an investor and then you need to invest in Europe, where is the asset that will actually give you a really good return just by where are the industries that make sense in Europe, where Europe has the biggest exports, where Europe have the biggest value, where Europe is building the value of Europe, right? Yep. And most of them happen to be correlated to the thesis of deep tech, right? So then I moved to...
The biggest one actually, I think, so far is UiPath. If I'm not mistaken, that's the biggest return? Or?
Depending... venture.
Yeah.
Yeah, could be.
I think it was, which is...
Well, actually, Helsing is also super strong. Well, there's a few, depending if you are including pharma or not, because then in pharma there's bigger ones. The only thing is it's biotech kind of
A different type of
it's
deep
the
tech.
different. Well, it's some of them are like have also electronics in it, so it depends which one are you thinking of. But yeah, in this the largest ones end up being on that space in Europe, right?
Maybe it's worth, excuse me, just to define a little bit deep tech, just briefly, roughly.
Yeah, I mean, I think the other day someone actually gave me the European Commission definition for deep tech, which I'm not gonna give it back. But
We can put it in the comments.
Okay. But so I mean, inside of deep, there are technologies that have a really rooted, are really rooted in hard technologies, right? Like it could be, for instance, sensoring. It could be tech bio. It could be robotics. It could be, so in most of the not all of them, but some of the cases will have hardware and software. Could be new space. Could be manufacturing when it comes to. In order to do the manufacturing, you have a huge engineering type of company or challenge that you need to solve. In that case, could be AI. Is actually deep tech in a. It depends. I mean, AI these days is everything, right? So
Yeah.
Not all of the companies in AI, but some of them that could put a layer of AI on top of what they are building. Right. So this type of technology, so this type of company, so for people to actually understand what they are.
Yeah.
And then so then I had that view, and then I moved to a pure VC doing space technologies and robotics, deep tech in general, based in Luxembourg. And then after that, I joined. That's how I ended up in kind of in the space of deep tech, and then after that, I got approached by one of the people that I respect most in the industry on a personal and professional manner. He's the CIO for a quite large family office. They were the anchors of a big portion of the hedge fund industry here in Europe. And he mentioned, hey, we're building a venture capital portfolio and a co-investment portfolio alongside that one. And I would love for you to help us
to be
build
part
that.
of it. Yeah.
So then I built the portfolio together with him for the venture capital side. That was done, and then the co-investments with a few co-investments alongside that. Yeah. But then, as we were coming back to the first question of all, at the point the market changed massively, and then the family that is behind the family office wanted to be in assets that were a little bit more core to them on the roots, meaning hedge funds, because they were kind of the anchors of the hedge fund industry, which makes total sense, to be honest, because they were looking for a different type of liquidity profile and a different type of research on profile, right? So it did make less sense to build more or anchor more on the direct investment in a way, and maintaining the venture capital exposure that they had in the family office to build a kind of a really sustainable type of portfolio construction from the family office perspective. And at that point in time, once that was the decision going forward, and then the venture portfolio will not change massively over the next 9 to 10 years, because you normally build relationships and enter into funds with the idea to stick around for the next 3 vintages of funds.
Yeah, makes sense.
So then I decided to leave. And that's when I was actually underwriting Vsquared for investing from that family office into Vsquared. So I thought, first of all, the team was great. And second of all, they had really interesting assets, completely different to other people. So, sorry. So I thought they actually were doing the things that most people get shy of doing, and they had when they invested in a company, what I realized was it was maybe not too popular with other people, but they had a strong view on that company, and they will go and help that company to the next level. Right?
And that actually aligns with your internal thesis that you had previously.
Exactly. And so I actually, when I was on the LP side, I was like, I really like this thesis. I really like what they're doing, and I really like the guys. They're awesome, by the way. And then So then I basically underwrote them for the LP to see if we will be investing in them or not. And then at the time when I was doing that is when I actually left. And then that's how one of the partners, she's amazing, and she was like, hey, will you consider joining us? And that's how I'm here now. I mean,
Which,
from that to, to say that I joined.
Yeah, shout out also to Herbert. That
yeah, thanks to Herbert, now I'm here,
But the problem is, Maria, this has been a disaster because, as you know, we wanted to cover many things related to Vsquared and the investment in Deeptech in Europe. And I've seen that you pushed the pedal in the last 3 experiences in Luxembourg with a family office and with Vsquared because you're running out of time.
Yeah, but we can have a bit more and then we'll
Okay,
go.
Because otherwise I was going to tell you we're going to do a volume 2 like in 2 weeks or something.
No more volumes.
Yeah, I should disclose as well that you normally don't do this, so I
no normally do it. I hate this. Let's put it out there.
I think even more. So it would be even better when you come in season 3 to do it
thank
again.
you. Yes, well, I will die to do it.
But then, yeah, okay. Following this, then the minimum is to express a little bit the
I can be a
thesis
little bit more.
of Vsquared and what do you do there?
We are a venture capital fund investing in Deeptech companies. So the verticals that we were mentioning before.
Which is your current job, by the way, just like
yeah. And in Munich now. And so it's basically new computing, sensoring, AI, and next gen software. It is new space. It is robotics and manufacturing, and it is tech bio.
Mm-hmm.
Or are the companies that we look at. Obviously, our most of the times where we enter into a company is when the scientific risk is gone, and we intake kind of a part of the engineering risk that it's entailed into these companies to get to the next layer. Some others are almost like finished with the engineering risk. Is more kind of like market risk, etc. That end up being between. We've done things in pre-seed, obviously, but it's kind of between seed, Series A, more or less. That's where we enter in most of these companies.
Can you elaborate a bit more on the ticket side, the investment approach with the company? Like, do you aim to lead the rounds, take a 15% of the companies because you get in early, or like?
Yeah, we lead the rounds, and the ticket will obviously vary depending on the. Will be like a lead ticket most of the cases, and it will vary between obviously the phases and the stage of the company, how much the company needs, because in some of these cases, we were saying like they're quite capital intensive, right? So it's not by Series C or Series A, you have a sizable round, right?
Pre.
Exactly. And then, that depends. But yeah, we tend to lead, and we like to lead the rounds, right? The ticket size will depend.
Okay. For me, what I like the most about the play of Vsquared is that I think that the companies that need the money in hardware and deep tech normally are the pure VC plays in the more pure sense of the meaning. I don't know if you agree, but rather than imagine that now a restaurant will say, I'm a startup, and I don't want to get in conflict with anyone that does that, but it's like, I'm a restaurant, therefore I need to buy like real estate and then put people in and then cook and then serve the food. Therefore, this doesn't scale properly good because you need more restaurants with more people.
Yeah.
While doing this, I know it's a very stupid thing to explain, but it's just to give more context maybe to some people that is not in the VC industry. Like, you're going to invest maybe for some years with many really good people that is highly expensive.
So basically that the year curve is basically more steep. That's what you're trying to say.
It.
Okay, that took long for saying that.
And I was going to keep going. But
I know. No. Yeah, it's like the J curve is way more steep than in any other industry at the end of the day. And these people need, so basically it's quite costly, it's capital intensive. But then when these things work, the growth is exponential in a way. So versus many other, not saying that the rest of the industries don't get me wrong. Look at other companies out there who has like tremendous exponential curves. with steep curves for
McDonald's is a great company, by the way, as well. But
no, I was thinking a different type of, like, not just Deeptech, but also other technology companies that many VCs invest in, and software companies that have nothing to do with tech, and they potentially need less of money to actually get into those types. But in these cases, it's just it's outstanding, right? Because you invest for a long time, because they take a long time to actually have something. But then the steepness of this curve after with the sales, it can end up that you have no revenues for like the first 6 years, and suddenly the next year you have like 100 million or 200 million revenues, and you're like, how this happened, you know? But it can happen. It's not like, because you have a kind of a milestone, and then when you that milestone happens, then you unlock significant portion of revenue, because those contracts get actually executed, right? So then you can benefit out of those contracts, and suddenly, and it's not a contract that just came out from yesterday. They came out from a little bit more time, obviously, but they were waiting for a specific milestone to happen to actually unlock that value.
do you actually, that number of 6 years, do you actually track it, like in the sense of normally our portfolio companies take 6 years development in order to get the first customer?
It's really. I mean, you cannot tell. It's not the same like a tech bio company versus a robotics company versus a AI company versus is completely a space company. I mean, it's really it really varies. It was quite funny. There's a PitchBook report coming out yesterday, I think it was, where it says that 30% of the companies take between 6 to 9 years to become. This, I think, is US data. I don't know. I need to check that. But it takes between 6 to 9 years to become a unicorn. 37% of them.
37% of the companies.
Which is the biggest ones then. Yeah.
The top quartile.
Exactly. Well, yeah. No, well, exactly. But like, it gets kind of like a curve in which 30% of them are in between the 6 to 9 years. Then there's more or less, I think it's between 3 to 6, more or less. There's like 20-something%. And then between 9 to 12, there's another 20-something%.
Okay.
So in a way, it's like between these angles is where you have most of the when they get created. But I don't know the data behind it. I'm just mentioning a report from PitchBook, so I haven't had much time to.
But it's good to have a framework or a.
Yeah, I mean, it also depends whose companies have put into the research. Which markets as well, etc. So I don't know if they have, I don't know how many of them they are or not to base these reports. So something to check, but it's out there.
And how? So you mentioned all of these technologies that scales exponentially, and in order to do that, you need to somehow do technical due diligence or have some deeper knowledge in the tech.
The good thing is, like in Vsquared, there's amazing people. With PhDs in different areas. So yeah, I mean, there's quite a depth, and then there's a lot of like good advisors and also including LPs that are able to underwrite pretty much. I mean, honestly, some of them are, super strong. Technically, most. I mean, from the team, I'm telling you, like, there's so many talented people in different angles and areas, and then from the network that is around Vsquared, I mean, they are the strongest people. In some of them, the strongest people that I've come across, and also not only technically but also as humans. So yeah, I mean, the good thing is like they can. We can underwrite a company in that front, thanks to, like, internally. And if internally we want to get supported by something, then we can also tap into different people that are really close to us.
Yeah, and how would you say you get to most of the deals? Because I guess many of the intellectual work is put or has been put in some universities, I may think.
Yeah, many. I mean, this is the same as many. I think everyone has different manners of getting into deal flow. So some of them will be universities, some of them will be network, some of them will be old co-founders or old founders that just refer us, other VCs that say, hey, I mean, I want to have like someone more specialized in this vertical. I'm a generalist fund, and then can you take a look? And then happy to invest alongside you guys, because you have more the expertise on these specific verticals, etc. And some others is like pure scouting, or you meet people, you go conferences, or also like you have a thesis. Like for instance, you can you want to invest in a specific theme, and then you're like, hey, I really believe in this. There could be something here. What are the companies that are trying to improve this current problem in society or in something specific? And then you start mapping who is doing something in that specific space.
Okay, that's super interesting, because then you would say that most of the investment come from a previous intellectual work on your side to say, I have these fields.
No. I mean, no.
These fields that I want to invest in.
I mean, I say one of them.
Okay, just one of them.
Yeah, but like one of the ways of getting into something is like you believe there is something there is something in one specific space for whatever reason, and then you are like, hey, actually, I do have a thesis of like this needs to be disrupted, or this is going to change over the next 5 years or 10 years, and there's a huge revenue to be made there. Companies that are going to build there are going to have like there's a pool of revenue that will be created there. So value creation on that specific vertical, and then you can explore who is doing something there.
Got it. And because now
I need to go.
I know. So I will just one last question. Thanks again for coming, by the way, before. You. But like, how do you envision the future? And you can take the financial aspect, the macro aspect in general, technology. I'll let you choose. Just one is enough because we don't have more time. But how do you envision the future?
I mean, I don't know. I mean, it's a really tough question for me to answer. It depends which angle you take. I do think that it needs to be. I'm gonna get the approach of at least Europe in a way. We need to work together more, and I do envision the future in which we manage to build kind of more of a united sovereignty to do things as a whole, as a unity. That's gonna be a hard one, yes. But I think it's a needed one, and maybe it's not because we do it because voluntarily we do it, but maybe we are forced to do it in a way, right? And but I think that needs to happen, and I do envision that. Hopefully, maybe I'm naive or I am a hopeful person or whatever it is, but I do envision that it needs to happen, and I think if that happens, we will be in a really strong position because most of the talent, and not most, but like there's a really strong talent coming out of Europe. We have a huge know-how, and I envision that to also building value and keeping the value within Europe, right? And I don't care which economy it is inside of Europe, but in order to do that, we need to bridge some of the fragmentation and that is going on in Europe at this point in time. So for me, the future will be a lot of political and issues in any country and all of the countries, but that will be solved, I think, by force, that we need to solve, and we need to unite, and we need to decide how to move forward. But I envision that to happen. I don't know if we will be worse before getting better, but I do envision that hopefully we'll get better at some point by a need to be united.
I like the view. María Juesas Portoles. Thanks a lot. And
thank you.
Yeah. See you in the next one. Ciao.